Welcome back to Wook Capital Management's weekly Wook and Review broadcast. I'm Wook Capital Managing Director Rod Alsman. I've got two of my teammates here. I'm going to have Joe Funicello and JP Park co-hosting. The plan today is to go through the newsletter material item by item, and then there's plenty of other things that we can discuss. It's not on the newsletter, but the details from the newsletter are available in the link in the @Wook Capital handle, as well as pinned. For those who've not joined before, audio is of course available on Twitter Spaces. Video is also available in the Wook Capital Discord. I'm sharing my screen and we'll kind of open different links and refer to different items, but I'll do my best for folks who are audio only to call things out. So Joe put this newsletter together for us, and we had a short week this week. We had the holiday. Oh, let me read this disclosure first before I get into things. Wook Capital Management, Inc. and its employees solely provide investment advisory services to family clients and do not provide investment advisory services to the general public. Furthermore, investments are highly speculative in nature and involve substantial risk of loss. We encourage investors to obtain advice from a professional investment advisor and to make independent investigations before acting on information that we publish. We cannot assure you that the information is accurate or complete. We do not in any way warrant or guarantee the success of any action you take in reliance on our statements or recommendations. Past performance is not necessarily indicative of future results. All investment decisions of an individual remain the specific responsibility of that individual. Joe, I need to just record myself doing that so I can just play the recorded audio in the future.
I don't know how we haven't thought of that yet.
Yeah, it popped into my head the other day and I just haven't felt like doing it. But
keep a tape recorder next to you when we do these calls and just press play.
Yeah. Well, it's funny. I participated in 2 interviews yesterday, and I actually forgot on the second one to read that, so we had to re-record the intro to add that in. Hopefully, nobody's going to be out there suing us. But anyways, so we got decent amount of economic data, jobs report this week. Today, yesterday was the strong ADP report. Today was the slightly weaker private payroll number. I guess all in all, not to spend much time talking about macro, at least not at the onset, unless people join and want to talk more about it, is that the jobs market's still healthy. Jobs are still being added at above the pre-pandemic average. Wages are still rising at a level that is still above that that the Federal Reserve would like to see. So all in all, the labor market is cooling. It's still likely too hot for the FOMC committee members, such that they're still likely to raise rates in the next meeting. The most recent futures pricing is showing a 93% chance of the Fed raising rates on July 26th. So, with just another couple weeks, you have to imagine there would have to be some pretty meaningful economic deterioration that would somehow shine through for that to change. So, yeah, but all in all, again, the real economy is resilient, continues to do better than just about everyone expected. I think we mentioned last week the kind of continuation of upside surprises that we've seen year to date, especially over the last couple of months. So, good news for the real economy. Maybe not so much for asset prices. Bond yields rose again today. There's been a pretty meaningful increase in the 10 years back north of 4%, for example, which is what drives mortgage pricing. It drives a lot of long-term borrowings. So as all else equals, those rates do continue to rise. You would think that the value of equities would decline. That has not happened yet, and equity risk premiums are historically very narrow. So definitely tread carefully out there in financial markets. There's you're not getting compensated a lot for the risk you're bearing in equities broadly. Okay, with that said, so just a couple things about the book club. Joe, I don't know if you've gotten the YouTube updated. I think you're a little behind. Obviously, welcome back to the US. It's nice to have you back on on the time zone that you can participate in these Friday calls.
Oh, I know. It feels good. It feels good. I'm still behind you on the West Coast here, but it feels good to be home. I have the book club Twitter space recorded. You can check it
Okay.
out on Twitter. It's not yet on the YouTube channel, but if you're on Twitter, you can watch the space and see like who was talking at what given time. And once it'll go on YouTube, you'll be able to watch it on the Wook Capital channel.
Yep. And just to recap, we talked about Michael Maubeson's Think Twice, which really it's not a specific investing book per se. I think it's more about improving one's decision-making frameworks and being more aware of cognitive biases that we as humans have and are susceptible to improve our decision-making process broadly. And of course, it could apply to investing as well. So check out the recording. I think it was a good discussion. Hope to catch some of you on the next one. So we do those book clubs the last Tuesday of every month at 8 p.m. Eastern time for about 2 hours. The next one is going to be Howard Marks' Mastering the Market Cycle. So look forward to that discussion the last Tuesday in July, which if we don't have it scheduled yet, Joe, let's make sure we get that scheduled, and that way folks can have it on their calendars. All right, so book club, yeah, and we're still just waiting on Nathaniel Popper to release The Degenerate Generation, which I'm eager to read, and we'll adjust the balance of your book club depending on when that gets released. But after Mr. Marks this month, we do have a great book that I have not read, and I'm looking forward to it. Nassim Taleb's Fooled by Randomness. So there's a few really good books left on our Balanced Beer book club, and I think we had some great reads earlier this year. So those are all available on the Wook Capital Twitter as well as our YouTube channel. All right, so first agenda item here was news out late last night. I sent it over to Joe before I fell asleep at like 2 o'clock in the morning, whatever it was Eastern time. So, we've talked a few times about Alibaba. It is on the Wookie watch list. Just as a reminder, the watch list is comprised of companies that members of the Wookie community, the Wook Capital community, have voiced an interest in. It doesn't mean any sort of recommendation to buy, sell, or other with regard to these stocks. I will note in my personal account, I do have a position in Alibaba. It is a calendar call spread on long, June 2024, $100 strike calls, and I'm short the $100 strike July calls that expire in a couple weeks here. So for that position, it was a wonderful day, a nice move. The stock did end up closing up 8%, so pretty substantial move for a multi-$100 billion market cap company in Alibaba. This is hopefully the resolution of the regulatory crackdown that first sent the stock tumbling a few years ago at this point. So if you kind of look back at the Alibaba stock chart and you kind of think back to where it was in 2020, 2021, there was supposed to be the potential listing of Ant Financial, which was owned by Alibaba. However, there ended up being some government crackdowns on big tech, threats of fines and breakups and the like. And now, as of last night, the reporting out of Reuters is that there will simply be just shy of $1 billion fine for Ant Group, which should resolve all of these investigations into anti-money laundering, consumer protection, corporate governance, yada yada. So it's a years-long regulatory scrutiny getting resolved, removes that overhang from the company. So Alibaba stock still trading down markedly from where it was back in late 2020 when it was looking to IPO Ant for close to $40 billion. So can't really read, I guess, too much into it. I mean, the Chinese government obviously doesn't want to fully scare away international investors. So I think resolving some of these actions and some of these, I guess, outstanding risk items for some of these mega cap Chinese tech companies might be viewed as favorable to attract international investment. But yeah, we'll see. Again, it's resolution of regulatory overhang. The stock reacted very positively today. However, Alibaba stock is still down. If you look at the 5-year chart, it is just a very ugly chart. It's lost more than half of its value going back, and it's still trading below its IPO price from 2014. So, to me, Alibaba, look, there's the Chinese idiosyncrasies to consider, but when I look at Alibaba and you look at how much the company itself has actually grown since IPO through now, we're talking about almost a decade now, 9 years as a publicly traded company. It's just a great example of how when you're paying a very rich multiple for future growth, even if that future growth does pan out, if the multiple derates, which it has here, it's really hard to get a return. So it's definitely been a rough slog for, again, Alibaba has some idiosyncrasies with SoftBank ownership stake and SoftBank's continued liquidation of its Alibaba ownership stake, which most of that's gone now. So if you're a chartist, you might view the chart as something of like an inverse head and shoulders, where the bottom that was seen in October of 22 might have been that that peak of the inverse head and shoulders, and perhaps it's now building up, to recover. But still, there's a lot going on with Alibaba. We've talked in the past about them going through the breakup of all these entities. So we'll probably talk more about it. But that major news headline out last night wanted to hit on. So anybody have thoughts on Alibaba or on China in general that they want to talk about before we move on to the next topic? If you're in the audience, feel free to come up and request to speak. You can reply via text to the thread, to the spaces too, if you can't use audio, and I'd be happy to get to the question. Otherwise, we'll keep on moving. All right. So, not seeing any hands up. Keep on moving through the newsletter. We've got Joe included this graphic that I thought was useful. Kind of the Fed has talked at length about financial conditions, and there's several different financial conditions indices out there. There's one from the Chicago Fed, there's one from Bloomberg, from Goldman Sachs, and all of these are looking to measure a mixture of the cost of capital, some consider asset prices. The one that I have on my screen, which was in the Wall Street Journal this week, is more oriented around, it includes equity prices, but it has mostly thinking about costs of debt. And overall, financial conditions had gotten really tight at the end of 2022, according to this index. They'd loosened markedly through most of the first half of 2023, which could be evidence of why asset prices reflated meaningfully year to date, at least certain assets. But that trend is now reversed again as of the most recent monthly data point. So financial conditions are again tightening. They're not particularly tight, but this measure at least is showing, again, it's how you slice it, right? Certain measures of financial conditions are going to tell you a different thing based on what goes into it. This particular measure is showing historical tightness, going back 15 years to the GFC. So while they've eased off of the tightest they were, as I noted in the end of last year, they're still fairly tight. And that should continue, right? As I said at the onset, the Fed is expected to raise rates at least one more time. 2 are still priced in before the end of the year. So while there's been all of this tightening, so far a lot of those effects have yet to be felt, I think. And we'll see how the balance of the year progresses. Um, and then lastly, or not lastly, kind of in line with that discussion around financial conditions, this is a graphic from Societe Generale, which was in the journal this week. I thought it was interesting because it was kind of showing the spreads between different groups of companies, and the large companies with weak balance sheets have performed far better year to date than large companies with strong balance sheets. And it's interesting because the small companies with weak balance sheets are the worst performers. So uh, the large companies with weak balance sheets up over 20% year to date. Small and weak are pretty much flat, albeit they had a short squeeze to start the year off. Folks remember the just rip roaring rally that happened through till kind of early February, when there was that abrupt shift in direction when the market realized, oh crap, maybe rates actually do have to keep going up. But look, there's a lot of borrowers who've pushed out their refinancing needs till 2025. Depending on if you've listened to some of these different spaces, people have addressed this and the idea of a maturity wall. And if short-term rates have not been cut by the Fed at that point, how much more expensive it will be for many companies to refinance their debts, or who may prove unable to refinance their debts and may lead to more bankruptcies. I mean, all else equal, look, clearly cost of debt has risen and seems like it will continue to rise. I think a lot of people are betting on a Fed loosening cycle in 2024 and hopeful that rates will return closer to neutral. But again, the Fed's been telling us for a while they think they need tighter for longer, higher for longer, and unless there's a crisis, like look, we had a serious banking issue. The Fed put a program in place that with the BTFP program that basically lets these banks tap a different Fed program if they need, it's not cheap capital, but if they need to tap capital from their loans that are marked down, they can put them up as collateral at par. So I mean, like, still unclear to me that we're not going to have more of a tightening credit issues. I mean, there was a few stories in Bloomberg and the Journal this week talking about different credit funds, raising capital and kind of licking their chops. I think the term that one of them used was like a slow moving car crash, something like that. But they're not seeing huge opportunities yet in distressed credit. But the view many of these funds hold is that it's going to get worse in credit markets, and credit spreads are still pretty tight. So yeah, not getting compensated that well for the risk you're bearing. And then kind of in that vein, I think it was interesting that your most shoddy creditors, your triple C rated junk borrowers, have returned about 10% year to date, while your safe haven borrowers, your double A rated corporate folks, only returned 3%. So again, year to date, junk has rallied, weak balance sheets have rallied, crappy stuff, and also big stuff has rallied. A lot of stuff's rallied, but yeah, that all else equal speaks to lower future returns. I'm gonna skip because we've talked about the China and the U.S. this kind of tit for tat about access to technology. I think we talked about it last week a little bit with some of the restrictions on what NVIDIA is able to sell to China. Just we'll note that this is kind of ongoing, another rule proposal from the Biden administration to restrict Chinese access to U.S. cloud compute. So it's just likely to be something we see, even though Janet Yellen is over there trying to sing kumbaya with China right now. So you keep kind of getting these actions by the U.S. government that the Chinese aren't going to view favorably, and then we talk about the desire to maintain good relations. So it's kind of tough to square that one. And the last prepared item that I had that Joe included in here, which I thought was interesting, was one of the artists formerly known as Bed Bath & Beyond's former brands, Christmas tree shops that they had sold off a couple years ago is being um, liquidated. It's also going through a Chapter 11 bankruptcy, or they filed for Chapter 11 in May. So it's funny, right? This former Bed Bath owned company filed for Chapter 11 a month after its parent filed in April. And speaking of Bed Bath, because we can't ignore what's going on there. Last night, they had an item on their bankruptcy court docket that advised they will not be pursuing the going concern auction that had been scheduled for today for their Bye Bye Baby business. What does that mean? Last week, they had an auction for the Bye Bye Baby intellectual property, the brand, that was bought for 15.5 million. This auction that was to be held this morning, it was supposed to be the going concern auction. If somebody wanted to buy the Bye Bye Baby business out of bankruptcy and to continue to operate the stores. However, there clearly was not a bidder. The company has now opted to move forward with accepting the bid on the intellectual property, which will be finalized on the 11th next week. And there's really nothing left. At some point in the next week or two, they're going to communicate more about the resolution of this bankruptcy proceeding. How much assets have been recovered for the secured creditors. It does not look like unsecured creditors will see any recovery. I checked today, and the bond for next year was trading at 2 cents on the dollar. And obviously, the BBBYQ equity holders stand behind those unsecured creditors in line for any recovery. So it's just stunning to me. I just can't wrap my head around the fact that Bed Bath & Beyond's bankrupt token is trading at a $210 million market cap, even though it's facts that there will be no recovery and the shares will be canceled. So I will note, since I'm talking about BBBYQ, I have shorted that in my personal account. I have about a 10,000 share short. So I am paying a very hefty borrow, but I'm quite confident that the shares will be canceled in short order. So I am putting my money where my mouth is, even though certain people on Twitter don't like the idea that their token is going to be canceled. So anyways, Joe, that's all I had prepared. I don't know if you want to add to any of that monologue.
I would just add that I would love to have a discussion between you and one of these BBBY believers. That would be a fun debate.
I don't really know what there is to debate. I guess we just have very different perspectives of
well, they reality. Would say the same thing. They would say, I don't understand. How could you possibly believe this isn't, going to change my life?
Yeah, it's really sad because I follow what some of them are saying, and kind of the bigger accounts really gets me annoyed, because there was one of them talking about, for one, there's this PP show where these guys just have been like coming up with fan fictions over and over about what they think is going to happen, and that Ryan Cohen is going to buy the business for a premium out of bankruptcy with here we go. Yeah, this guy who has a chimpanzee and a suit that I have on my screen. I saw what he was tweeting. He said, quote, "You're witnessing probably the biggest future case study in BBBYQ's Chapter 11 turnaround, led by a board of M&A specialists and Holly Etlin. Elaborate methods of clearing toxic debt and nefarious creditors to prepare the valuable assets of the company to be sold to an activist investor whose previously expressed interest and owns all the relevant trademarks, capital, and experience to breathe life into this company. $5 billion in revenue in a huge market of baby goods will turn into $10 billion with the right board and increase profits with great capital allocation. If you're sitting there uninvested, hoping it goes bankrupt so you can tell people I told you so, maybe you should reflect inwards and reevaluate your life goals and priorities." So look, people can say whatever they want. They're entitled to do that. But the last line in his diatribe said, "hoping it goes bankrupt." Well, Mr. Ape It's in bankruptcy proceedings presently. And thus far, the bankruptcy proceedings haven't gone well if you're looking for a recovery, right? They sold Bed Bath & Beyond's intellectual property off to Overstock for about $21 million. Bed Bath & Beyond, the chain, will no longer exist in the physical world. It's being liquidated. Bye Bye Baby, we just talked about what's going on there. Also couldn't find a buyer. It's going to be liquidated. Someone is going to buy the intellectual property pending approval next week. That's $36 million from the sales of the intellectual property. They've obviously generated cash from the liquidation of their inventories and stores. They've sold off the leases of those stores through a bankruptcy process. So it's really just, it's hard to even understand if it's all just a psyop by somebody writing something like that, which now has over 10,000 views and almost 250 likes, right? It's hard to know if that's really what that person believes or if they're just doing it for the likes. But, there's just a lot of, I don't know, a lot of silliness out there still.
Yeah, Rod, according to Mr. Ape in a suit, you should be reevaluating your life choices right now because you're not all in on a bankrupt company.
And look, I think the issue is, think back to 2020, right? You had Hertz file for bankruptcy, and it was a company that had a lot of assets, right? The cars, that all of a sudden, very, very quickly amid this process, became far more valuable as the economy kind of got turned back on and demand surged. So, like, you had a lot of weird stuff that happened over the last few years that I think a lot of people have incorrectly inferred is normal. And a lot of them are almost proud of their ignorance, that they don't do any due diligence, or at least what I would consider due diligence. Their version of DD is, well, fan fictions, frankly. So, look, I'm all for education and trying to get better as investors, but I just can't understand what's going on with people still showering money. Like I said, BBBYQ, $210 million market cap for something that is assuredly a canceled equity in short order too. It's not going to take very long. They've sped run through this bankruptcy. So I don't know. Clearly I'm doing something wrong. My largest position's market cap is about half of this token's. But markets can do silly things in the short run. But look, it's a small crowd in here. It's a summer Friday, so we'll definitely wind this down quickly. Definitely by 5 if there's no kind of questions and the like from the audience. I see Mile High Stock Guy is in here, a good friend of GMEDD and of Wook Capitals for many years. Not sure if he's in a position to chime in on anything he's seeing in markets. I don't want to put words in his mouth, but I know he's been pointing out that, at least from a chart perspective, which is his area of expertise, a lot of charts still look quite bullish. And I've kind of heard that reiterated more broadly. So there's a lot of bullishness out there. The Fear Greed Index that CNN puts out has been in extreme greed for, feels like, more than a month now. It's been in the cusp of extreme greed for a bit over a month now. It's been either in or just below. Again, you can see on my screen if you're following along. But we're at the highest levels on that index over the last month than over any period in the preceding 12 months. It's summertime. A lot of professionals are taking off. We just got through the first half of the year, so there's lower volume this time of year. Things that have kept going, things that have gone up a lot could continue to go up a bit more. We don't have the Fed for, as I mentioned, about 3 weeks. Like between now and then, could stocks keep going up just because it's the path of least resistance? I think there's a very reasonable case for that, but I don't know. I guess my sense from trying to listen into different spaces conversations and Discord conversations is that many market participants are very ebullient, euphoric, um, hype AF, whatever adjective or phraseology you'd like to inject there. And while it isn't obvious why stocks would go down, that's when they're most apt to, when something comes out of the blue and reshapes expectations. So right now, I mentioned earlier in another space I was participating in that if you look at the next 12-month forward PE, price earnings on the S&P 500, we're right around 20 times forward earnings. Which, what does that mean? You're getting about a 5% earnings yield on the index. You can get about you can get more than 5% on a 1-year treasury, right? And we talked about the 10-year earlier. You can get 4% on the 10-year. There's really not much of an equity risk premium given what you can get risk-free from the US government or from certificates of deposit and how much you're paying for future earnings. And I've made the point on other episodes about how high the price to earnings to growth ratio is, especially for technology. So PE over G, right? If you have a price to earnings of say 20 times, which we just talked about the market writ large having, if your earnings are growing at 20%, right, as the denominator, your PEG would be 1. All else equal, you want that PEG to be lower as somebody trying to buy with an eye toward intrinsic value, or at least buying more cheaply relative to the earnings of the enterprise. Right. So if you had a stock with a price to earnings ratio of 5, but that's growing earnings at 10%, your PEG is 0.5, which could imply that it's undervalued. The PEG for technology right now is closer to 3, which is second only to the dot-com bubble in extreme overvaluation based on future earnings growth. So to me, what has to happen is either AI and other technological enablement yields meaningful productivity improvements, cost takeouts, et cetera, that lead to market revisions upward in future earnings growth. That could happen. It's not outside the realm of possibility. Much more likely to me is that expectations are too high and that equity prices will be beaten to submission at some point. The Federal Reserve doesn't want to see equity prices continue to reflate. It makes their inflation fighting job more difficult. So we talked about financial conditions earlier, and when you look at equity prices, those have helped them to ease. But when you look at the interest rate and credit related portions, those are tight. So I'm not calling for any sort of crisis or anything. I'm just saying that broadly, equities are richly valued. You're not getting compensated well for the risk you're bearing, and that there's a lot of hype out there. I would also point out with implied volatility at mid-teen levels, it spiked a little bit this week, but it's still, I think, is lower than it's been since pre-COVID. Looking at the 5-year chart, it's as low as it's been since pre-COVID. So I think if you've gotten a great start to the year, maybe you were long a lot of tech, long a lot of the less than savory balance sheets we were talking about just before. Now would be a good time to lock in some gain. You could consider there's various different ways, right? Do you sell a bit? Do you enter some sort of a hedging strategy? Do you sell, say, covered call to fund put options, a collar? There's a variety of ways you could position yourself. But right now, insurance is cheap. And the time to buy insurance is when you don't need it, not when it's overpriced and the house is on fire. So right now, things are very shiny. There's a lot of sun out. And I would argue insurance is worth considering. But clearly I've been awfully wrong year to date in a view that technology has been over. Technology to me is just look, AI euphoria is hard to understate, and there's real value that'll come to the economy through that. But who as a company will tap into that profit pool, other than somebody that's obvious like an Nvidia, and well, it's obvious to everyone. So Nvidia is trading at a level where we've talked about in the past what sort of growth it needs to see for investors to see a forward return. It's hard to square the math, but again, capital inflows and sentiment is very much more important than fundamentals in the short run. There has been a lot of, as I just was talking about, positive sentiment. There's been a lot of retail inflows, especially into the high flyers, your Nvidias, your Teslas, your big tech names that everyone knows, these signal names. So, while today was potentially good if you're looking to see the rally spread out to more sectors, like today we had energy up over 2%. Obviously, crude was up over 2% for most of that, driving most of that. Materials and industrials are the next best movers, which are typically pretty cyclical industries. You had laggards that are your more defensive industries like consumer staples and healthcare, and utilities were the bottom three performing sectors on the day. So again, you can't ever read too much into one day or 1 week or even 1 month. But the fact that smaller companies outperformed larger companies today, the IWM closed up over 1%, whereas the Qs and SPOOs closed down about 30 bips apiece. That could be a sign that we're getting a little bit of this broadening out, but I think there's still a ways to go to see if this is truly a new bull market, and that the folks who have not yet risen will rise, or if it's just a very challenging time in financial markets, a very unprecedented time in financial markets, and that people that have gone balls long are going to get rug pulled soon here, which is what I think happens, but we'll see what happens. So there's my monologue. As I mentioned, it's a small group today. It's a Friday on a shortened week, so I'm sure people would rather go and enjoy the sunlight and touch grass than listen to me ramble on. So I don't see any questions. Joe, I don't know if anybody sent you anything, or if you want to add anything to that before we kind of wrap up.
No, nothing else to add. I hope everyone looks forward to some big changes we'll be making soon. If any, get more and more people in our community and take advantage of what we already have grown with GMEDD, and bring more people into this retail investor community so we can find the next GameStop, right? That's the goal. Everyone would love to do that. So if we can put together our resources to make that happen, help everyone achieve alpha together. That's the goal.
Yep. So a little teaser. Again, I don't want to commit to timeframes that I can't be certain of, but yesterday we did record. I did record a couple of interviews that I'm looking forward to being published. One was a group interview where I was among the interviewers of a certain CEO that members of the GMEDD server are likely familiar with. So we're looking forward to publishing that as soon as it's feasible. And I also had the opportunity to participate in an interview as the interviewee, talking about my largest personal holding that we also hope to, in very short order, publish some additional research on. So as always, we appreciate and we thank you for your interest in Wook Capital. Always looking to make this programming more valuable for people. We totally get the timing is not ideal, especially in the summertime. So we hope to very soon be sharing some news around restructuring this time. But for now, we'll be here every Friday at the close with our Wook in Review. And you can also tune in on Wednesday nights at 7 on my personal account. I host a market open mic discussion that will usually run for a couple of hours. So Wednesdays at 7 Eastern, Fridays at 4, and then, of course, our book club's last Tuesday of the month at 8. So thanks, folks, for tuning in. We'll wrap it there. I hope everyone has a great weekend. Stay safe out there. Cheers.